Public anxiety is currently locked on the prospect of a financial collapse. Headlines are screaming about a crisis worse than 2008, pointing to staggering U.S. debt as the primary indicator of systemic risk. This anxiety serves as a distraction. While we watch the debt clock, a separate, more immediate risk forms in the silent infrastructure layer. In early 2026, the four largest hyperscalers, Alphabet, Amazon, Meta, and Microsoft, committed $725 billion to capital expenditures. It is a massive concentration of capital dedicated entirely to the expansion of artificial intelligence. This expansion is moving into an administrative void. Federal and state authorities are effectively removing the legal constraints that would typically govern an industrial build-out of this scale. The fear of a paper debt collapse misses the actual trajectory. We are witnessing a massive deployment of capital that assumes physical capacity will simply manifest to meet it, regardless of the materials required. The federal strategy is one of active clearing. Under Executive Order 14365, the Department of Justice is directed to challenge state-level AI regulations, enforcing a minimally burdensome national framework that favors rapid development. As of April 2026, the agencies tasked with oversight have largely remained silent. The DOJ's AI task force has not initiated litigation against state laws, and the Commerce Department's scheduled evaluations of these regulations have not materialized. Financial regulators are following the same pattern of deferral. The Federal Reserve and FDIC have explicitly excluded generative AI models from their revised risk management guidance, leaving the most significant technological shift of the decade outside the supervisory perimeter. The leadership driving this build-out is operating without a ceiling. Industry founders like Larry Page have signaled a willingness to risk total bankruptcy rather than cede ground in the AI race. The regulatory environment has treated legal boundaries as optional variables. This has created an institutional expectation that AI development can proceed as if the physical world has no capacity limits. Policy debates and administrative deferrals only matter if the bottleneck is legal. If the constraint is physical, the entire regulatory discussion becomes irrelevant friction. Microsoft's $80 billion unfulfilled server backlog isn't caused by a lack of chips. It is a lack of electrical substations. The capital is ready, but the hardware has nowhere to plug in. A widening gap exists between the administration's goal to lower AI's theoretical cost and the grid's reality of raising operational costs. Law is deferred, but infrastructure costs rise exponentially. While public discourse focuses on deepfakes, private capital's real competition is for megawatts and cooling water. Human policy cannot preempt thermodynamics. An executive order doesn't produce a gigawatt of electricity. The most accurate forecast of this collision is found in the prediction markets, specifically in the Kalshi contracts for August electricity prices in the Texas ECART region. Current pricing reveals capital anticipates severe grid stress. The order book is shifting away from the growth narrative into the reality of a constrained system. At these levels, the market treats physical infrastructure limits as the only binding variable, effectively discarding the policy narrative. This institutional realization is happening in the background. While the public remains focused on the debt clock, capital is positioning itself for a direct collision with the limits of the grid. Sophisticated investors have moved past the illusion of infinite scale. They are now betting on the immovable constraints of energy physics. The loop is self-reinforcing. Capital demands more capacity, stressing the grid and triggering further deregulation, which only invites more capital to compete for a finite supply of power. This stress is being passed directly to individuals. In regions like ECART, retail load is projected to grow by 14% through 2026, driven almost entirely by data center expansion. Households are paying for this $725 billion build-out through their monthly power bills. The cost of the infrastructure required to support AI is being socialized across the entire ratepayer base. An infinitely expanding digital system cannot run on a finite copper wire. The physical limits of the material world will dictate the final capacity of the network. This impending breakdown is a mathematical certainty. The physical world is enforcing a boundary that no amount of capital can bypass. The definitive test of this theory arrives with the June ECART monthly outlook for resource adequacy. This report will provide the data on how much reserve remains in the system. A report showing tightened reserve margins will spike the prediction markets, triggering the math of immediate capital rationing. When the headlines focus on AI policy or synthetic media, look past them. These are variables that can be optimized or ignored. Anchor yourself in the physical constraints. The megawatt hour and the substation are the only metrics that remain absolute in a system of infinite capital. Physics dictates the final capacity of the system, regardless of what capital demands or what policy permits.